Hello, thank you everybody everybody for showing up and early. I am pulling in Pete Swan, our CEO. There he is, who I will also make presenter. Um, excellent. Oh, am I still here? I may have crashed my thing. Oh, there we go. That was a very scary beach ball for a hot second. Hi, I'm Ryan Nash. I'm the CEO of Gust. This is one of our first kind of community sourced events, and Pete is our CEO. He's going to kick us off, and we're going to talk rapid fire through raising your first professional round. So take it away, Pete.
Awesome. Let me see if I can figure out how to share my screen.
Oh, and while Pete's doing that, we will make room for Q&A. If you want to use the Q&A section on the right or the chat, you can use the chat for informal, say hi, say where you're from. But if you have any questions along the presentation, please throw them in the chat or the Q&A. I will cherry pick ones that are relevant, because I kind of know what's coming up in the presentation. And if anything needs more clarity, we'll save it to the end where we can do a Q&A on some of the ones left over. All right, and Pete is, I think, getting set up. We lost your video, Pete, but I don't see your screen yet.
Okay, hopefully this will now work.
I have made you the presenter as well as I've made you everything you can be in the limited space of GoToWebinar.
Okay. Let me see.
Oh, we have some nice, hey, Manny. Oh, I'm like, we have somebody from New Jersey who's using Gust Launch, and it's Manny, who I've talked with several times. How's it going, Manny?
Okay, let me see here.
Oh, you're sharing your full screen now.
How's
There we
that?
are. That looks good.
It's always fun when every piece of software has a completely different screen sharing experience. All right, so thank you all for coming today. What we're going to be talking through today is, at a very high level, all of the things you should be aware of as you kind of enter into your first professional-ish round. We say professional-ish because we're gearing this towards your first round with investors that are kind of outside your own personal network, maybe verging on professional, and may have expectations beyond what your friends and family or in-network investors might have. And what we find at this point is that often founders have that moment where they realize that they haven't actually thought about what's going on inside their business for a really long time, and they are scrambling to get a whole bunch of stuff together. And that's the type of stuff that we're going to try to cover today. There is a lot here, and a couple caveats as we go. First, we aren't lawyers, so this is an overview of how things work in the space, but please don't consider it legal advice. If you do want any of that, we can put you in touch with some great startup attorneys. We will make notes available afterwards that go over the full session. I think we will also be recording this. And as always, the most important thing is that your company gets the money that it needs to actually take the next steps. But we think that the next most important thing is that you understand how that money actually affects the trajectory of your company, and that it affects it in a positive way that leaves open your optionality. So what we're going to do today is try to prepare you with what you need to know to save time, money, stress, and equity. So the first thing we're going to focus on is company structure and basic diligence. There's not a ton going on this early in your company, but there are still some expectations and some checkboxes that you'll need to have checked. A, to satisfy investors in a basic diligence process, and B, just to actually get money into a company. And the goals here are to avoid speed bumps with investors where they ask you for something and you have to chase down a whole bunch of people who you haven't talked to in 6 months, or you have to engage a lawyer to get a whole bunch of stuff written down and documented before you move on. And that process is typically called corporate cleanup, and it can be pretty expensive. So what we're trying to do with these things is to avoid those speed bumps in conversations and avoid additional corporate cleanup costs. So the first thing we're going to hit is incorporation. You need to create a business. You need to obtain a federal tax ID from the federal government, and you need to open a bank account associated with the business so you have a place to actually put the funds. Investors are not going to write you a check personally. They're going to want to invest in some business entity. So when you're creating a business entity, typically investors in the US, which is where we're going to focus today, if you are looking to raise money in the US from US investors, you will likely want to be a Delaware C Corp. There is some innovation in the space, but by and large, this is still the gold standard for startups looking to mobilize that equity to bring in investment from equity investors, angel investors, and VCs. The reason that tends to be is that Delaware has a huge and thorough body of corporate law, and that has actually been duplicated by many states. But what Delaware still has an advantage around is that there has been way more corporate litigation. So the laws have been tested way more in Delaware, and how they will be applied is much more clear because of all that testing. And another good thing to understand just in startup legal in general, how the law will be applied in the US is super important because it's not just the letter of the law as written that matters, it's how the court will actually interpret it. So if you do have an LLC, this may be a good time to start thinking about converting it. Now you may be able to get investment into an LLC, especially if you're doing a crowdfunding round or working with less sophisticated angels. That's totally fine. As I said, most important thing is that you get the money you actually need to grow your business. But just keep in mind that eventually you will likely need to make the switch. And the more things that get attached to your entity, the more expensive that switch can be. So we think it's a good idea to get it done early, but with success usually comes extra money. So you can't always pay for it later. If you want to, it will just cost more. And then when obtaining your federal tax ID, you will need your federal tax ID, A, to open a bank account, and B, to get something like a DUNS number, which is a common requirement for getting an app in the Apple App Store. That process is usually pretty quick. Oh, Nash, did you just jump in there?
I'll jump in a sec. Keep going.
Cool. That process is usually pretty quick via the IRS's online system. However, if you and your founders do not have somebody on the founding team that has a US tax ID, either an SSN or an ITIN, then you'll have to use the IRS's fax system, and that can take considerably longer. During COVID, I think it was up to 60 days. It is back down to a more reasonable amount, but it is not immediate. So if you are incorporating in the US as founders without a US tax ID, leave a little bit of extra time, understand that getting your EIN is going to take a little bit longer. And the last thing you want to do is open that bank account associated with the business so that your personal finances and your business finances are separate. Keeping those things separate is part of what is going to give you limited liability in your company and protect your personal assets from the business's assets. In order to effectively do that, they need to be effectively separate.
Great. We got some great questions right in on this thing before you go to the next slide.
Awesome.
The first one's from Kimber Falkenberg, sorry. Does your Delaware C Corp status matter at all to where your bank account is held and what type of account is required? For example, having a DEC Corp, but a Texas-based bank account.
No, you can generally open an account in any state. However, what is a common thing with a Delaware corporation and startups that form Delaware corporations is that they also eventually foreign register in their home state. So if you incorporate in Delaware, but all of your founders are based in Texas, and you go and open a brick and mortar bank account in Texas, that may trigger the foreign registration requirements. Typically, foreign registration is a one-time fee, another form filing, and potentially a yearly fee.
And I do know specifically Texas, having a bank account in Texas does not trigger foreign qualification requirements. I only know that through some random trivia.
Not random trivia, day-to-day trivia.
Too much registration. And Kimber already has the foreign registration gun, so good job. Some more great relevant questions here. This is probably demystifying C Corps and LLCs. Gama Mendez asks, if you have a Delaware C Corp, should you also file an LLC?
Typically, you don't need to. However, there are some business structures that might require it. If you have a startup that is primarily a technical business, but also has a services arm, like maybe somebody doing tax preparation, um, I think Wave Accounting is probably a good example. They provide tax software, and then they also have a stable of accountants that will jump in and help. That services business may be a separate LLC. There may also be structures like that if you're moving in some financial services, or if you're doing anything where you're actually spinning up a fund to pool money from investors.
Awesome. And the last one, Olga Pavuka asks, is it possible to make it, I'm assuming the Delaware C Corp, via Stripe Atlas?
Yeah, absolutely. So there are a bunch of services that you can now use to form a corporation. Gust actually also builds one, which we'll mention at the end of this, but those are typically good options. One thing that you do want to consider, both in terms of who you choose as an incorporation provider and ongoing legal services, is that startups and startup fundraising are a very specific focus and niche. So generally, it is a good idea to utilize providers that have startup experience and understand the startup fundraising process, so that you don't waste time and money.
And I will also add, while Stripe Atlas is, we like the guys over at Stripe, we use Stripe ourselves. Gust Launch is all that and more. It is my favorite company as a service solution if you're starting a Delaware C Corp. And one more relevant question here is, we've got somebody who's currently an LLC, will be converting to a C Corp, but they know it's pricey. They'd like to get commitment from investors before converting. Do you know if investors will take issue with that?
It depends on the investors, but I think that is a very, very good idea. Anytime you can increase the certainty that money is going to come in before committing to something that's going to cost you money, that is always a great idea in startups. So you can certainly tell them that that is your plan. It may slow down investment if you get a bunch of commitments and you really want to get the money in, but then you have to go through the process of transferring things. You might want to start looking at how to do that conversion and maybe assembling some of the docs. If you're curious, we can certainly help you out. Come talk to us at gust.com/launch. We'll help you navigate so you can get some of the pieces in place.
All right, and yeah, so that's excellent. Carry on.
All right. So next up, we have formation and corporate governance. A lot or some incorporation services will stop at incorporation. You will form in Delaware and you will end up with a shell of a corporation. A lot of founders think that incorporation stops here as well, but realistically, once you incorporate, you actually have to go through a few other steps to fully form the corporation in the eyes of Delaware. And again, the main thing here is that fully forming the corporation is what actually establishes that corporate veil and separates you and your assets personally from the assets of the company. So actually going through and doing all this is a key point to actually be able to legally sign agreements that will hold up in the future and won't have you chasing tail when you're about to have money hitting your account, and actually protecting you and your co-founder's liability. Some keys here: adopt your bylaws, establish a board of directors, appoint officers, and have at least one shareholder. Your bylaws outline how your corporation is going to work on top of the corporate code that it's based on. So in addition to the Delaware corporate code, your bylaws will talk about who votes on what, who's allowed to vote on what, in what form they're allowed to vote, whether they can vote by writing or you have to meet, kind of the cadence of when different pieces of the company will come together and work out different types of strategic decisions. These can be super dry, but as a founder, especially a first-time founder, it's really good to read through them. I was very surprised the first time I did it and was like, oh, this is actually a really useful construct, because now I know specifically what roles I need to operate in and generally what cadence I need to use. So in my CEO hat, I am operating day to day. These are my responsibilities. Every month, it is good to think of myself in the board member capacity so that I think at a little bit of a higher level and balance the shareholders versus my day-to-day CEO. And then at the shareholder level, okay, I need to think this way every quarter, every 6 months, every year to really think about the high level business and whether that's going in the direction that the shareholders will want. So essentially you have a few levels. Your board of directors will sit above the CEO and officers of your company. They will help at kind of that monthly basis. They will have to sign off on things like stock grants, investment decisions, things like that. You'll have your officers. Delaware requires a CEO/president and a secretary at least, and you'll have to have at least one shareholder. And again, your shareholders sit kind of at the top. They don't typically interact on a day-to-day basis, but they do have control over who's appointed to the board and things like that. So establishing these 3 layers is what allows you to actually formally sign off on all of these things. Their signature is required according to Delaware law. So if you go through and start signing legal agreements, especially things like stock grants or investment instruments without establishing your board and without having shareholders, you don't actually have all the people in place to sign off. And now typically at the beginning, the founder or founders will occupy the majority of these positions. So sometimes people will think like, oh, it's just me anyway, and I signed it, so that's fine. But not having things like board and shareholder resolutions are classic corporate cleanup tasks, and not having those things is going to cost you down the line. Next up, we have stock issuance to founders and early team members. Some key things here. Promising shares is not the same as issuing them. Be intentional about your equity split. Leave yourself some wiggle room. Vesting, must for everybody. Spousal consent, don't forget about it, especially if you're in states with community property laws. And don't forget your 83B election. We'll go through these individually really quick. In regards to promising shares versus issuing them, a lot of times we see folks think that they've done their equity split and actually issued shares just because they've had a conversation and said, oh, okay, we'll be 50-50 shareholders, or like, yes, you'll get 1% of the company. While having a verbal conversation or an email does have some legal standing, it is not the same as actually granting the stock. To actually grant the stock, you do need documents signed by your board of directors and the CEO of your company and the grantee to formalize that grant. Often those will come along with a certain acceptance of certain rights and restrictions around transfer and things like that. And that grant date will start a clock on some other filings you need to do. This is really important to do because as you accumulate value in your company, the share price is going to go up. So very early on, it is very easy for founders and early team members to buy into the company very cheaply and do that in a way that has very low tax impacts. As the share price goes up and you promised somebody equity a year and a half ago, but don't grant it to them for another year and a half, if that share price has gone up significantly, they may have to pay way more upfront or take a much bigger income tax hit to actually buy in and get that equity that was promised to them. And their upside may also be limited because they're buying in at a higher share price and will now have to wait for it to go even higher before they see some actual financial delta there. It can also have some issues with what's called QSBS holding period. Often for corporations, the initial stock, as long as it's held by the initial holder, qualifies for this qualification. It entitles the holder to write off up to $10 million in capital gains tax if they hold the shares for 5 years. But that holding period only starts when you actually grant the shares. Next is be intentional about your equity split. Again, we often see founders come in and just kind of say like, oh yeah, we'll be 50-50. We're both going to put in time and effort here. It's really important both for your co-founder relationship and for your legal bills and tax consequences that you actually think about your equity split in terms of what everybody is bringing to the table. Time, responsibilities and roles, how much money they're going to put into the business, how much impact that they're going to have on fundraising, what their previous experience looks like, all of that stuff. If you do that, then you will have a much lower chance of having you and your co-founders realize 6 months in that you are not living up to each other's expectations, and now you have to reshuffle all the stock and deal with all of the legal and financial consequences that come with that. You also want to leave some wiggle room. So typically, if you're starting a startup and you are the only founder and you're not sure whether maybe you're going to need some co-founders, it does not make sense to issue yourself all of the shares in the company. The ownership and voting rights in your company are only ever determined by the number of shares that have been issued. So you don't need to issue yourselves all 10 million shares of authorized stock to own 100% of your company and control it. You just need to issue one. That is a terrible idea from a tax perspective, so don't just do that, but it's totally fine to issue yourself like 3 or 4 million out of that 10 million. You can always issue yourself more later, and that will give you room to bring on other co-founders, advisors, contractors, and also carve out an option pool when it comes time to take on that investment or hire some W-2 employees. The reason that's a good idea to do is because if you do issue all of your shares and have to issue more, each time you want to issue more than your authorized shares, you have to go back to the state of Delaware and amend your certificate of incorporation to increase the number of shares, which costs anywhere between $200 and $400. And when you do that, you also have to wait for that to happen. So it puts a little wrench in the works in terms of actually granting somebody shares. And you may have to do things like refresher grants for existing grant holders to make sure that the percentages stay the same and things like that. The third is vesting is a must for everyone. Vesting is the primary mechanism that is going to protect you in the event that something goes wrong with somebody who is adding value to your startup. For founders, we often see a 4-year vesting schedule with a 1-year cliff. That gives you a year to say, as the CEO of the company, this relationship isn't working out. And if it doesn't work out within that year, your company automatically has the right to repurchase all of those shares and bring them back into the fold without leaving what's called dead equity on the cap table, which is any significant equity that is held by somebody who is no longer adding value to the company. This is super important because even if you have that conversation with your co-founders about roles and responsibilities and take the time and be diligent, startups are a messy business full of uncertainty. So very often in that first year, things might change considerably. So even if you are co-founders who have put in a year of work before you've decided to incorporate, it's important to vest your shares. This is true for founders, for advisors, for contractors, anybody who's not buying shares as an investor, primary mechanism to protect those shares. It's also really important from an investor perspective because investors will look at your equity and they will want to see that the people who hold it are incentivized to continue to provide value to the company post-investment. So a good way to think about your vesting schedules for people is to line them up with the lifetime of the relationship. Again, that's typically 4 years for founders, though we're seeing in the space now, since companies are staying private for longer, that people are even extending that up to 6 years. And then spousal consent. This is primarily for states that have community property laws, but it is typically considered best practice. Basically, if you do have a spouse, you get them to say, for the purposes of this grant and the voting rights and decisions, my spouse has rights to this. And if they transfer to me due to community property laws, I am still bound by the agreements that my spouse signed, so I can't go and transfer them or sell them in a way that doesn't match the agreements that my spouse signed. And last, but certainly not least, don't forget the 83B election. When your stock is granted to founders and early team members, typically you are granting common stock, and the vesting for those grants is what's called reverse vesting. And reverse vesting means that when the stock grant happens on the grant date, the person who was granted the shares gets the voting rights for them immediately. So from a corporate governance and control perspective, they own them and they can vote them. However, what the vesting says is that any unvested shares can be repurchased automatically by the company for the original share price if the relationship with the grantee ends. So what the IRS says is, oh, okay, you can vote these shares immediately, but you have a substantial risk of forfeiture that vests over time. So if you have a 4-year vesting schedule for your founder stock, and hopefully your share price has gone up considerably from year 0 to year 4, you will still be paying income tax based on income tax events that are happening in conjunction with your vesting schedule every month. And at that point, you will be paying income tax on the difference between the original purchase price and the share price at the moment of vesting. So this can be a huge income tax hit for founders if the share price is going up in the direction that we want it to see for all startups. So what 83B allows you to do is say, hey, IRS, I am going to elect to pay all of the income tax on the grant in the year that I was given the grant, regardless of the vesting schedule. Typically for founders, since they're paying cash for that grant, that income tax, that delta between what they paid and what it's worth is 0, and you can minimize your income tax burden to 0. You can only do this within 30 days of the grant date. And currently you have to go through a crazy arcane process of signing and printing multiple documents, mailing multiple via certified mail to the IRS, along with a request that they send you a stamped copy back. So don't forget to do this. It takes some time, but it is absolutely worth it in the best case scenario for your company.
Cool. We got 2 relevant questions on this before you move on.
Sure.
So Gino Herring asks, as a single founder, what's the best way to give equity to valued advisors? Do I use a safe document or something else?
So you can find a great advisor agreement called the FAST that is published by Founder Institute. It is very similar to the advisor agreement that we have on Gust Launch, except that it also comes with some directions and documentation about how to think about compensating advisors with equity. So typically what you'll see is anywhere between like 0.1 and 0.4% of your total authorized shares as the grant allocation for an advisor, but it will change based on the state of your startup and the level that your advisor is participating at, whether they're just providing some introductions and some general guidance, or whether they're really unlocking things in a highly competitive or regulated industry. So that's the FAST, capital FAST. We'll include that in the show notes that we send out afterwards, so you can find it. But that is a good one. A SAFE is typically not affiliated with an advisor unless that advisor is choosing to contribute money as an investor to your company.
Yeah, and largely, generally, advisors almost always just early advisors compensated with equity only, no cash. That's more of a contractor relationship, and it's usually those small fraction of a share grants. And the vesting schedules, I don't know if you caught this, Pete, the vesting schedules for advisors are usually a little different. The
Yes.
most common one is a 3-month cliff and a 24-month vesting period, because advisors are generally there to get you to the next hump, whether that's a fundraising round, an M&A, a partnership, product to market, whatever. They're usually not providing advice for the duration that something like a founding team member would.
Yeah, that's a great point and a great way to reinforce the general point. Your vesting schedule for a certain person should line up with kind of the proposed length of their engagement.
Cool. We have a couple more here around this. Kyle asks, they've been operational for 3 years, I'm assuming as an LLC and or some kind of entity because they have vested equity already. Is it recommended to start vesting schedules over again when we reform the company to a C Corp?
Oh, super interesting. So you can backdate vesting. But if you've been running this company for a while and you are reforming as a C Corp, the presumption is that you're doing it because you need money to grow. So it wouldn't be uncommon if you went to raise that investors would want to realign the vesting schedules based on the trajectory of the company at that point. So you could certainly backdate vesting. You can't backdate a grant date, but you can start vesting in the past. That would be totally fine. You could probably find some middle ground between, the original date versus, versus now. And also depending on how you convert the LLC, that may in and of itself dictate that. So you'll have to look at kind of your plan of conversion and how that works.
Cool. And the last one, I'll answer this one real quick because you've been doing all the talking, Pete. David Hawkins asks, can first-time employees, non-founders who are granted stock via an ESOP or an EIP, an employee stock option plan or equity incentive plan, do they do the 83B election, or is that just for the founders? So 83B elections are only for common stock grants that have a vesting schedule, because that, like Pete was saying, what is vesting is the irrevocable right for the company to take it back from you. Stock options are not, the ownership is not owned by the employees until they exercise those options. And that's a whole different tax treatment with option exercise and things like that. Probably enough for a talk in and of itself. But the long and short of it is option grantees don't have to worry about 83B elections.
Correct. That said, it is possible to make a straight common grant out of an equity incentive plan. And in that case, if you made a straight common grant out of your EIP, then they would still want to file an 83B.
Cool, moving on.
All right.
These are great questions, but I know we have a lot to get through.
Yeah, absolutely. Next up is intellectual property. This is all the stuff that you are generating that is actually giving value to your company. And what you want to do is make sure that that value actually belongs to your company, not the individuals who are producing it. This is key for when you go to engage with investors. Again, they're investing in your company. As much as you are a part of that company and you are a signal that it will do well, they want all of the assets of the company to actually be owned by it. So a few things here: make sure all founders have signed intellectual property assignment agreements. Make sure all contractor agreements assign intellectual property to the company. Make sure advisor and contractor agreements include non-disclosure provisions, and think a little bit about your patent strategy. The first of these is probably the most important. As you're making your founder grants, your founders should also be signing founder intellectual property agreements. These will transfer all previous work that's been done by those founders into the company, and will make sure that any work that they do henceforth will also be assigned to the company. Doing it in conjunction with the initial stock grant is great, because at that point, everybody has an incentive to do it because it's tied to their equity incentives. If you let it slip after that, it is more and more likely that it will become more difficult to get it done. Founder intellectual property assignment agreements also typically have some non-disclosure in them and some non-compete in them, and function as super lightweight, like non-employment employment agreements. Very often founders don't really specify whether they are treating themselves as contractors or employees, because they don't expect either of them to sue the company, but this will get all of the other stuff that you would typically get in an employment agreement in terms of safeguarding your IP. Having all contractors sign agreements for intellectual property is super important. In the US, by default, if a contractor is working for a company, what they generate is licensed perpetually to the company, but is owned by them. So you want to make sure you actually have a contractor agreement in place, and you want to make sure that that contractor agreement stipulates that the intellectual property is owned by the company. If you're using offshore contractors or going through like an offshoring agency, make sure you discuss that with them as well. Advisor and contractor agreements should include non-disclosure provisions and non-compete. Typically they do, but make sure that everybody signed one. They are easy to do. They can also help you formalize that relationship and communicate it more effectively to potential investors. Instead of just saying Snoop Dogg is my advisor, you will actually have an advisor agreement signed by Snoop Dogg, which is arguably way cooler and way more powerful in the eyes of an investor. And then patent. You can file a provisional patent relatively inexpensively for somewhere around $100. A provisional patent is basically just a grab bag and catch-all. Often founders will basically dump everything in there. You basically just want to make sure that your provisional patent covers everything that you might want to turn into an actual patent called a utility patent later. Filing that provisional patent gives you a year to decide whether anything is worth actually utility patenting. And then the process of converting that provisional to one or more utility patents is when it gets expensive and when you actually have to loop in a lawyer. So a provisional patent can be a good first stop. It's relatively easy. We actually have some cool services that I'm blanking on now that can help you, but that can be one strategy for just getting broad strokes of a patent and intellectual property protection strategy in place. The other option, and this is mutually exclusive, is public disclosure. If you write about what you're doing, if you write about the novelty in your invention, it has now been disclosed to the public, and that is establishing prior art. So that if somebody goes and tries to patent it in the future, you can say, no, my prior art prevents that patent. But the tricky bit is you now can no longer patent it either because it is public information. So those are good strategies unless you are in deep tech. If you are in deep tech and you are, working on a novel cancer treatment or gene therapy or vaccines or doing something that is super cool and you have invented an autonomous robot, then it may very well be worth looking into a more explicit and targeted patent approach prior. But if you are building a software business, you may be able to do a little bit less and spend a little bit less money.
I think you basically just addressed this, but David, again, for algorithms, is it best to go patent or trade secret? I'm pretty
Ooh,
sure that's what you just, it's going to be, and it just depends, and that's not our area of expertise kind of thing.
yes. If you have any questions, it is good to do some more research and engage with a lawyer. Again, if your algorithm is really novel, you can do a bit of reading to understand really what a novel invention is and what the requirements are. That will be helpful to understand whether your algorithm is even patentable. If it is patentable, then even getting it in a provisional patent will give you broad protection, so you have a year to figure out what the actual strategy should be.
And similarly, Eduardo asks, they're developing an AI software. They're not planning to apply for IP, which I assume means like a patent protection, but they're using trade secrets as well. Is that enough? Kind of the
Um,
same answer.
it's kind of the same answer, and I think the thing to remember is these things can provide value independently if you plan to license them, and part of your go-to-market strategy is to license them to other people to utilize. In those cases, a patent or other intellectual property protections can be valuable in and of their own right. But if you are not going that route and it is just internal to your company, then you may want to question whether the protection is necessary prior to actually building traction and value in the company.
Cool. Carry on.
All right. Next up, we've got fundraising terms. And our goals here are to avoid surprise dilution and keep your options open. By dilution, we mean as your company grows and you sell more of it to investors, there will become more shares total in your company, which means the percentage that you hold will go down over time. And this is very typical and very normal in equity fundraising. But the key is you don't want to be surprised by how much of it you're getting hit with at each round. Typically, depending on what you need, you are selling somewhere between 10% and 20% of your company at each round. You don't want to think you're selling 10 and end up having sold 20. The other is keep your options open. Safes, convertible notes, typical VC path are all really great for the winners, but they are optimized for a care for the winners and ignore everybody else world. So as you get into these things and you step into your first funding round, it is important to understand kind of the fundraising trajectory that these instruments put you on so that you understand what options you actually are leaving open to grow your business. So convertible instruments generally. Safe and convertible note are the most common. Generally, they are a promise of shares in the future. So they are not shares of your company now. They don't affect your common stock allocation. You're not creating a preferred share class for investors to buy into. They are just a document that says, I'm going to invest money now. And in the future, that money will convert to shares in the company in a structured way. Typically, they will convert to preferred shares at a qualified financing. Typically, that's your Series A. And your series, when you see the word series there, that is typically referring to the fact that a new class of stock will be created to be sold to investors. So you'll see sometimes Series Seed, and then Series A, Series B, Series C. The main difference, convertible notes are debt and safes are not. And they're both designed to reward early investors for their risk with a discount or a valuation cap. Discount lets early investors buy preferred shares cheaper than the new money investors are going to. And a valuation cap sets a ceiling on the valuation at which the investment will convert. Both of these are meant to reward those early investors for the additional risk they're taking. And both of these strategies basically mean that there are more shares than are initially negotiated in that preferred share round. Valuation cap is by far the more complicated of the two. A discount is relatively easy. If your preferred share investors negotiate $1 per share, then your discount investors with a 20% discount get to buy shares according to the amount of money that they put in and a discounted price of 80 cents. The valuation cap is a little bit more complicated. So first thing to understand is that it's an investor-facing valuation. It is not meant to be the value of your company today. It is meant to be the value of your company once you put this money to use with some discount. It's typically determined by all of the company information. So how much traction you have, who's on your team, things like that. Comparable raises for people who match those numbers, and the amount of money that you need to actually get your company to the next level, and then the amount of ownership an investor wants. And on the other side of that is the amount of ownership you are willing to give up to get what you need. And a valuation cap can be pre or post money, and this is dependent on the definition of company capitalization. So the pre-money, post-money valuation cap stuff, first thing that's important to understand there is it only applies when there is a valuation cap term in the SAFE for convertible note. If you're working with a discount instrument, then the fact that it's pre or post money doesn't matter. So the most recent version of the YC SAFE is a post money valuation cap. What that essentially means is that any other investment you take in via convertible instruments will not dilute the YC SAFE holders. So this is pretty powerful dilution protection for them. So what you need to be aware of as you're looking at these things is, the post-money YC SAFE is very much tailored to YC companies. So if you're going to go through YC, you're going to benefit from that network, you're going to get investment from them, and you're pretty sure that your Series A is 18 months to 2 years down the road. You take in a specific amount on this YC post-money SAFE, you understand exactly how much of your company you have sold, and you ride off into the sunset. That is great. Where you can get into trouble is if you do that, not understanding when your Series A might be, and then you get into a situation where you have to take multiple bridge rounds via convertible debt, whether that be SAFE or convertible note. All of that additional convertible investment is just going to dilute you and the early team members. It's not going to dilute those post-money SAFE holders. So it's a very powerful anti-dilution protection. So managing the complexity of all of this. It's really good to cultivate an understanding of how these instruments work. We will be doing more talks that deep dive into this. And it's possible to just go and read the YC SAFE instruments. It will make your brain hurt. It is math heavy. It will make you realize that you should have paid more attention in high school algebra, but it's there if you want to spend some time with it. It is pretty thorough. We've gone through it a few times. It will really help you start to get an understanding of all of this.
The circular math is wild sometimes. We're getting some LOLs
Yes.
in the chat, so.
Yeah. And then using different types of instruments can make things vastly more complicated. We worked with a founder a few weeks ago who was raising and raised from some individual angels and then raised via a syndicate and accidentally used a different instrument for the syndicate and the individual angels. And the level of math we had to go through to help them understand how to model the dilution was crazy. So if you can stick to an instrument and stick to a path, it's really helpful. Again, if you need money into your company, sometimes your options are limited and your investors may push an instrument on you. But if you understand how the instruments work and you can advocate for the path that you've chosen, that can really help simplify things. And then the last is use a cap table software. Even if it's just a spreadsheet, there is enough out there now for cheap enough that it is worth having this under your belt so that you can really start to understand without having to do all the math yourself, how your own ownership works as the company continues to grow. And it's also worth keeping in mind as you're mapping out your capital strategy that there are new and interesting things happening in early stage capital, particularly if you don't want to go VC rocket ship, burn money and grow as fast as possible. You do have other options. There's revenue-based financing. There are challenger VCs that are concentrating on, numbers-based fundamentals businesses and betting on building a portfolio of those. So if you're interested, do a little research first so that you can align your instruments and your capital strategy with your intentions for the company.
Oh, wonderful. That's a great segue into two really good questions we have here. I'll answer the first one to give you a break, Pete, but I think it'll lead into the second one. So David asks, do safes have to convert to preferred shares, or you can set the terms on the safe so it will convert into existing common shares? So safes by their very nature are supposed to be like lifted straight from the YC site. The YC Post Money Safe literally has a phrase in it that says this has been unmodified. However, if you work with a law firm, you can create any contract you want. Whether or not it has case law and a lot of stuff behind it is up to you. So you could create a kind of fundraising document that does some fancy stuff. By default, safes are intended to go into a preferred round of qualified financing. There's some language in there to cover like a downside liquidity event, like a dissolution of the company or kind of a fire sale. And there's like some cash out terms, but it's not really intended to like go into a common equity sort of instrument. There are some other instruments out there like warrants, obviously stock options and whatnot that convert to common, but they're usually not used for investment. I guess warrants can be sometimes.
Yeah,
And then, oh, go ahead.
I was going to say that's an important note. The reason why YC safes and convertible notes are popular is because they are simple and they are the same document. So investors are saying, I know exactly what this document does. I know what I'm signing up for. At least the sophisticated ones who have read them and understand what they're doing.
Or had them
So
explained
as soon
to
as
them.
you start, as soon as you start to change things in them, you are undermining the simplicity of the vehicle, which is the whole reason is it exists in the first place.
That's a great way to put it. And Rebecca's got a killer question. She says, if I heard you correctly, it is fair to leave options open and depend on the investor preference. So whether it's safes or convertible notes, she's sharing that she had an angel group that tried to pin them down long before due diligence. And our answer was it depends on the investor fit. Was that a wrong or right move?
Again, the money and the investors are the biggest thing, right? If those were the investors that you believe could add the most value to your company, and they were willing to give you the majority of the money that you felt you needed to get to the next step, then deciding between the terms of a specific safe or convertible note might not be in your best interest. But if you are working with investors who are less sophisticated and are just bringing money in and aren't necessarily bringing other value, that may be a time where you want to be a little bit more careful about who is bringing the terms to the table. And I'd say as long as you understand how these instruments work, then you are in much less danger and in a much better spot. They're all meant to come out as win-wins for everybody. It's just in your best interest to understand exactly or at least directionally what happens and what the conventions are and the mechanics are, so that, okay, you get into this with this investor, like that may limit some of your next options, but that may not actually be a bad thing.
Yeah, that is a great answer. And let's see, we got a couple more. Somewhat related, Rowena asks, for friends and family, what's the most common instrument? Oh, this is a good one. Depends
Oh,
on
yeah.
who those friends and family are.
So yeah, friends and family is a super weird term. What we have started thinking of it as is pre-seed. It's people who are close to you, people who are investing in you because they are primarily mission driven or just very early investors. They're not typically professional investors motivated just by financial outcomes, right? They are betting on you. They're within your personal network. So if we combine it to those folks, then typically at that stage, your company hasn't demonstrated a ton of signal, right? So you don't have revenue, you probably have very little traction. Maybe you have a product in market, but you're pretty far away from product market fit. So you haven't really generated a ton of confidence that the company is going to be successful. You're likely also working with investors who aren't doing this primarily for financial return, so they may be a little bit less sophisticated in terms of trying to come to a valuation cap or a valuation of the company. And it's something that would be tough to do for sophisticated people as well because there's just so little information that early. So in those situations, you may more typically see a discount or a valuation cap that is heavily informed by industry standards or is relatively favorable to the founders. Nash, anything to add there?
Not to that one. One last question on here, and I know we've got about 8 minutes to get through a couple more slides. Kyle asks, why would an investor prefer a safe versus a convertible note? Convertibles sound more attractive with the debt component. I'll answer this one. It's really based on people's experience, where they're coming from and what they're trying to do, and sometimes it's just straight up ignorance. Investors are people too. Sometimes they just follow the crowd and they hear a lot of noise out of, startups get YC safe, so they're like, no, I want a YC safe. Other times they have a very opinionated portfolio play and they're like, no, I want debt because I'm balancing my portfolio based on preference stacks, and in case some of these companies aren't going to work out or they turn into what they call zombie companies, they can actually get their money back with maturity dates. Notes clearly have more protections for investors, and they're still, I think, by and large, if you take in all 50 states and kind of deals, they're probably more popular in sheer volume than safes are at the moment. But everything we see in this space is like a pendulum. Notes swing to founder friendliness, and then some investors get burnt and they want a few more protections. This is exactly what we see with the YC safe, which it used to not have a cap. Now it has a cap because clearly some investors got burnt someday just holding on to a safe that never converted. So why do investors care? They're kind of like you in some ways. It could be their preference, it could be their experience and their sophistication.
Yep, and I think a couple more things with the safe in particular. There is some argument that signing a safe starts the qualified small business holding period for investors. That hasn't really been tested yet, but there's some conjecture that could work. And we mentioned before, for anybody who's working along the lines of the winners are how I make my money, then they are trying to get these deals done as fast as possible and get into deals that they think are going to be moonshots. So their emphasis is on speed, and they are less concerned about what happens with the companies that don't hit an exponential growth curve.
And here's a good one we're still gonna have to answer. Kimber's full of them today. So friends and family folks are possibly not accredited. What do you say about taking their funds? If you can get 50,000 from a friend, I've heard that the legal expense is almost not worth it, but unsure of how hefty that is. And, is there a level where I should abstain from taking unaccredited money, or a level where I should consider it?
Oof. Yeah, so this one's tricky. First, if somebody's got 50K to give to you, then they may actually be accredited, even if they hold options in like a $10 million company that may accredit them. So first, check and see if they can get their accountant or lawyer to sign off on the fact that they are in fact accredited. If they're not, under any circumstances, then think very hard about taking that money, because it's a lot of money for somebody who doesn't have $1 million in net worth or isn't making over 200K a year. That's probably a good chunk of change being invested into a very risky venture. You want to think about that from a personal perspective between you and the potential investor. If you are going to go the unaccredited route, you may also want to look at your business and see if it is a community-based play. If it is, then crowdfunding or a community round may make sense. And that is at least one way where the platforms are set up to do the compliance stuff for you and file the exemptions in a way that is less burdensome than some of the things you might have to do under Reg D or the 506 exemptions. So you may want to look at going that route.
Hopefully that helps. Let's keep going. I got a couple questions saving for the end. We're nearly
Cool.
there.
I'll try
We're probably
to
going to go for a
speed
little
through.
bit. Yeah.
All right. So option pool, not too much here. But the most important thing is to determine the appropriate size of your pool with a hiring plan. Don't just take a percentage based on, oh, 20% is industry standard. You should understand how you're going to mobilize the money you're taking in when you fundraise. Part of that is understanding who you're going to hire and what percentage of equity that they're going to command. Use that to understand how big your option pool is. It's in your best interest to have your option pool be as closely bound around the number of people you need to hire and the amount of equity you need to mobilize as possible, because anything outstanding will dilute you at future rounds. And then 409A valuations, this is the valuation that is meant to be the value of your company right now. When you actually start to issue options, you will likely get a 409A valuation. This is done by a firm that is separate from your company. They take a look at all of your company numbers and mechanics and come up with a reasonably justified share price for your common stock. By doing this, you get safe harbor from the IRS to actually grant it that share price. These are good for a year or up until you have a material event, which is a significant change in your company, often a fundraising, a merger, acquisition, et cetera. But that's what gives you safe harbor. You will have to do that. That is why people typically use common stock early on, because it's cheaper from a regulatory standpoint and legal standpoint, and it's easy for people to buy in. Securities compliance, we just touched on this a little bit. But it's good to remember convertible instruments are securities, even though you're not selling stock. If you're raising from accredited investors and not generally soliciting, you're in relatively safe territory. As soon as you start to talk about the terms of your round and advertise your round in a venue where people may not fit the accredited investor definition, you may be falling across that general solicitation line. And that is when you want to start talking to a lawyer or a crowdfunding platform that employs lawyers and will help you navigate testing the waters and a public raise.
I have a cool relevant question here. I tried to get into intro this slide, but I missed my chance. But Gino asked a question, which I think is actually kind of an interesting question that people don't think about a lot, which is how do you officially open a round? Is it just notifying people that you're interested? Does it really matter, how much money you're raising or contribution levels or anything?
Yeah, a round is kind of a fictitious beast. There are two components to it. Like the first is potentially the SEC. But once you file a Form D, for example, after or in conjunction with getting your first investment, you can generally raise in and around those terms from the same types of investors for a long time, up until you decide not to, or your circumstances change, or you want to change the exemption under which you're filing. Sorry, I talked a lot there and then realized maybe I didn't hit the exact nature of that question.
I think we got it. Gino, if there's any more clarity, just use the Q&A, but I think that was
Oh,
what
I
at
guess
least I was
one other
getting.
thing to note is that often folks will start raising on a convertible instrument, like a SAFE or a convertible note. They will raise some money at a certain set of terms, and then they will change those terms so that later investors are getting slightly less advantageous terms and getting compensated a little bit less because they're risking a little bit less. So often you'll see folks start with like a valuation cap of X and then change it to Y and then change it to Z as they're filling out the money that's coming in a specified raise.
Cool. Gino's cool.
All
All
right.
right.
And then to the plugging portion of this otherwise educational presentation, we do build Gust Launch. It helps with a whole bunch of all of this, so you don't have to think about it and you can go focus on your business. We do incorporation formation, founder IP, stock grants, 83B, corporate bank account, NDAs, fundraising documents, cap table and round modeling, and even stock option plan and 409 evaluations when you're ready. Over here on the right, you'll see our incorporation experience. We also, this is what your dashboard looks like. We help you manage all the compliance and stay up to date on taxes and things like that. This is your cap table where you can issue equity and all that jazz. And you can sign stuff, including board resolutions so you don't forget. And you can model all of these fancy things so you get a better understanding of how these things work.
if this whole presentation seemed like a lot, we have built software to take a good amount of that work out of it, and we're here for the rest of it.
Yeah, and there
Um,
are other options as well. If you do have questions about this stuff, as I said, we'll be doing more events to dive into the details. You can always come find us and talk to us, and we are happy to answer questions, even if they point you away from Gust Launch.
cool. So we have a couple questions I saved till the end. Kimber, thank you very much. You asked some of the best ones, and we'll get to yours quickly. Quick one, JD Ryan asked, can this help somebody out in Australia? Anybody can open a Delaware C Corp or establish a Delaware C Corp from any given country. It's all about if you actually need a US-based entity to either get into the US market to raise funds. But we're more than willing to help out international founders and set up Gust Launch with if a US C Corp is what you're going after. So first question from Kimber, she heard that some investors thought that if you're doing business in the States, you have to foreign qualify in every state. And they're a SaaS company and they're planning on selling to everybody in every state. Do they have to run off to every Department of State's website and get set up?
No, this is when you will want to maybe talk to a tax advisor and come up with a plan. Hit us up and we can put you in touch with ours if you'd like. They do relatively inexpensive consultations and they're great. Generally, what will happen is you will have to foreign register if you have employees in the state or you establish some other significant physical presence in the state. Otherwise, with the Wayfair decision that was passed in like 2014, if you're selling SaaS into states, you will eventually have to pay sales tax there. So you will have to register with the state in a separate capacity to eventually pay sales tax there when you hit certain thresholds. And typically that sales tax is assessed based on where your buyer is, not where you are. But companies like Stripe, I think, just acquired a company called TaxJar last year that is meant to help with this. So you will have other options for complying with those types of things. And sometimes that does overlap very confusingly with foreign registration and your yearly filings. So it can be good to talk with a tax expert on that. But generally, you don't have to foreign register just because you're selling SaaS in a state.
Yeah, and I think the confusing point is there's economic nexus and there's physical nexus. Physical nexus triggers foreign qualification, which is basically you got to do a thing every year or so, and sometimes mean states like California might charge you an additional tax. Economic nexus is like you're selling stuff. We don't care if you don't have a headquarters here. We don't care if you've never put your foot in our dirt. You're taking money from our citizens and they're giving it to your product. It's usually a threshold of a couple $100,000 of annual sales that establish an economic nexus, and that's when it's a sales tax. Sales tax might trigger a foreign qualification, maybe, but it's good to get tax jar-like advice or accountant advice on that. Cool. Let's see. We got two more questions. Haritosh asks, this is back to kind of IP stuff. They have two companies with patent pending algorithm, but they need investment for just one. If the investors choose to trust, then is that possible? I'm actually not clear what
Well,
that
I
full
think
question is.
maybe what they're asking is, can I get investment into company A by saying it owns the intellectual property from both company A and company B? So yes, you would be relying on investor trust. And again, early on, if they are close to you, they may be willing to trust you. As you get closer to institutional or professional investors, they will likely not value your company based on intellectual property that it does not actually own.
Cool. Couple last minute questions in here. Oh, this is a great one. What factors are taken into account when talking about the valuation of a startup? This is from Teddy.
Sure. So we actually build a couple of tools. One is the startup evaluation and feedback engine. The other is the pre-money valuation report. You can find those on Gust. Basically, the factors are your team composition, their previous experience and education, whether they've had previous exits, what area your business is in, how big the addressable market is, what other companies in that market or in that general business strategy kind of look like, what other raises have happened within, say, the past 18 months for similar companies that are planning to grow similarly, and then your traction. If you're a B2B business, that might be LOIs or actual enterprise contracts signed. If you're a B2C, that might just be sales. If you're, a social or a consumer-facing app, that may be daily user activity and things like that. And both of those tools will kind of point you in the right direction there to help you understand what factors go into that. You can also look at things like the scorecard valuation methodology, and there's been some other stuff written that will break it down, but generally they're all the same.
Cool. And Kyle's got one more question, and this is a great one actually. It's kind of like a throwback. They're talking to some angel firms, and they say they only do equity. They don't do notes or safes. And what's our opinion on that? Seems like the worst option. However, if they've got money, and I'll take a crack at this one.
Yeah,
This is actually how it used to be done. So you raise what's called a preferred round. You'd create new equity. So you're not selling them your common equity. You're creating what's called preferred shares. You're negotiating a value of the company, and then you're selling them shares at a premium because those shares have more rights. They're generally the first out in a liquidity or an acquisition event, and they have some additional voting rights and other like carry-on rights or whatnot. And that's how angel deals were done. There's probably a lot of angel groups and firms out there that still would prefer to do what they call a priced round. The documentation got a little heady, a couple decades ago, and convertible notes came on the scenes to like accelerate things so that you could defer specifically the valuation of the company and all the complex terms to a later round just to get some early money into the company. But if you have investors who are sophisticated enough and you feel comfortable enough talking about the valuation of your company, selling equity directly is actually the most straightforward way to know exactly how much of your company you've given away in a funding round. You can literally say, I just raised $1 million for 10% of my company. That's it. And it's a lot easier going on when signing convertibles and making sure you know the notes and how they interplay with each other, and then maybe having to do a bridge round and eventually one day realizing your dilution actually got a little out of hand. So that is not a red flag by any measure, unless they're doing something really arcane and it seems like it's a bad smell. But if it's an angel firm, if it's got like good credentials, that's still a thing that gets done. We actually have some sample docs that I'll post in the chat as well. We'll put in the follow-up resources called the Series Seed docs. These are just annotated, lightweight, early priced round documents just to help you get familiar with something like that.
yeah, and that would be great to read because the other thing that you want to do is make sure that they're willing to foot the additional legal costs for doing this, which if they've templatized it and done it a bunch might be negligible. But you also want to have some counsel look it over because it's essentially a novel doc that is coming from them. If you read that annotated Series C doc, it will probably give you a lot of the basic information so you can start to understand the terms, but you may want to engage counsel, which would be good to do anyway as you're raising, just to get their opinion on it and make sure that you have a little bit of leverage.
Cool. Last thing, Paratosh put some clarity in there about the IP situation in the companies, but it's a little beyond our depth and we're out of time. I will say next week, Paratosh, we have a event specifically about IP asset protection and law. We're going to bring in a law firm to do that, so I'll be sure you're on the invite to that, where we might have a better expertise around that in particular. But other than that, that's all our questions. We're only 9 minutes over.
All right, not too bad. Well, thank you all for being here. We were super psyched to do this. I hope it was valuable. Come find us if you have follow-up questions, and keep an eye out for events in the future. We'll be deep diving into IP. I think we'll likely do another one on safe and convertible note mechanics, where we actually look through modeling scenarios and things like that moving forward. And yeah, we'll see you soon.
Thank you, everybody. The questions were wonderful. There's a lot of love in the chat and the Q&A, which I really, really appreciate. You're making my night. Have a great week, everybody.
Thanks all.
Don't worry, I will end it. I have to end it.